So at this point in my career, I've helped hundreds and thousands of real estate investors across the country, and it blows my mind that so many different people tend to make the same mistake, which end up costing them tens of thousands of dollars. Now, for those of you guys that don't know me, which is probably most of you here on YouTube, my name is Daniel Kwok. I'm an 8-figure entrepreneur and real estate investor. And in this video, I'm gonna share with you what the 3 most common mistakes that people tend to make when it comes to real estate investing, how to mitigate them, and ultimately turn it around so it can actually make you more money. So here's mistake number 1, is being taken advantage of. And yes, those words magically just popped up on this easel. That said, here's the most common scenario that I tend to see over and over again. Person wants passive income by investing in real estate. Person starts looking at online platforms like Zillow, LoopNet, Redfin. Then person usually ends up working with a broker. Broker usually sells that person on an investment property. Then the person, rightfully so, doesn't know how to run the numbers or do due diligence on the property, and they end up buying the property hoping that it'll go up in value, as opposed to looking at how well the property is actually going to perform starting day 1, which is what veteran and expert real estate investors do. This one scenario that I just described to you, like, this is the number 1 mistake that people tend to make that end up losing them tens of thousands of dollars, and even worse, sets them back year after year when it comes to their real estate investing journey. So of course, how do we mitigate that? Well, here's the golden rule. Think about who is incentivized to do what. And that's one of the things that always bothered me about buyer's representatives, and which is why I typically don't use them, is because they're incentivized, their paycheck is tied to how much I pay for the building. As in, they're paid more if I pay more for the building, which now there is an offset, right? There's a disalignment when it comes to financial incentive. Now, what I'm not saying is that all brokers are bad. I've worked with great brokers in the past, and there are brokers today, yes, even today, that are still wanting to help you and absolutely have your interest in mind. But that being said, most brokers, like most people, are just at the end of the day looking out for themselves, and if there's a financial disalignment, it's at least something that you should be wary of. So ultimately, what is the solution? Well, this is gonna sound really obvious, but it's something that 99% of people don't do, and if they do it, they don't do it at the right level, and that's to hire an attorney. Now, I know what you're thinking. Oh, Daniel, this is so obvious. By the way, in my head, you have an Asian accent. But it's not obvious, because what most people tend to do is rely on the broker for all the legal documents, or somebody else for the legal stuff, because they want to save money, because it's too expensive. But I can tell you from experience and the hundreds and thousands of people that I've helped, that a lot of times when you're doing your first deal, or your second, or your third, or your fourth, the only person who may actually have your back in that deal and making sure that your interests are protected is most likely going to be an attorney. Now, if you're already hiring one, or if you plan on already hiring one, don't do what 99% of first-time real estate entrepreneurs do, which is hire based on proximity. And proximity is, oh, my friend's dad is an attorney, or hey, my dog's sister's cousin, babysitter's uncle happens to be an attorney. That's what you don't want to do. You want to hire a great one and the right one, which is specifically a real estate attorney that is used to helping out people with their very first deal. And on a side note, this is what separates average entrepreneurs, good entrepreneurs, and great entrepreneurs. The average entrepreneurs will actually hire just to fill in a role. A good entrepreneur will actually hire based on how well they do that job. And a great entrepreneur not only hires somebody who will be amazing at that job, but they also hire based on missional and cultural fit as well. So that being said, here's my number 1 tip for how I've hired amazing attorneys in the past. And I always do it based on referral, and not proximity referral, but more so experience referral. And what I mean by this is asking people who've actually been there and done that and accomplished the things that you want to accomplish, and asking them for their team. One of my favorite ways to do it, especially if I'm investing in a new area. So I live in Illinois. If I want to do deals in Florida or Virginia or Texas, then what I tend to do is I'll go on places like meetup.com or Eventbrite, and usually without fail, I find at least one real estate investing meetup. Whether it's a RIO, which is a real estate investing association, a lot of local markets have them, or even just any old meetup about real estate investing, I'll find whoever is hosting that event. It's usually somebody with a good amount of doors and a decent sized portfolio, and then I'll cold call or cold outreach that individual, asking them who they use as an attorney. And unlike a lot of other things on your team, attorneys are usually contacts that people feel abundant and open to sharing. So again, that's what's worked for me and a lot of other people across the country that I've helped in the past. All right, mistake number 2, which is fear of the market. Now, I see this all the time because fear oftentimes is the dictator of decisions, and usually micro decisions lead to culture, and culture dictates action and status quo. Now, when it comes to the market, there are 2 different types of markets. There's when, and then there's also where. Usually, a lot of people tend to focus on when, because everybody wants to buy properties when the crash happens, and everyone remembers how everybody lost a bunch of stuff in 2008 and 2009. In fact, I remember when I started in real estate as a college student, people would always tell me, especially the professors, oh man, that's a very dangerous and risky business. Remember what happened in 2008, 2009? Now, I'm not saying that there's not going to be a crash in the future. I don't personally think it's going to happen in the housing market when you look at a lot of the data and the research, but I do believe there's a lot of research and metrics pointing towards a crash in the investment space, especially in the commercial real estate market. But as I've learned from myself in my own career and a lot of my mentors who've been there and done that, there are 3 things to consider when you're thinking about the when market. Reason number 1, which is the reality that there will always be a reason to not buy a property. Now, obviously in hindsight, we know that 2009 through 2013-14 was a very ideal time to buy real estate. We were seeing double-digit cap rates and really, really good cash flow. But let's be real, there are still a lot of people in the media going around telling people, oh, don't buy it, now's not a good time. Why would you buy it right now when the economy is doing terrible? No one's able to pay their rent, right? And then as soon as 2014 to 2015 and 16 and 17, when I was buying a lot of my properties, people were telling me, oh, there's going to be another crash, right? Like you don't want to buy it now because, the value is not going to be great and all this stuff. But the reality is there's always going to be a reason not to buy. And if you're a good real estate investor and you know what you're doing and you're following the rules of success when it comes to real estate, then you'll be perfectly fine no matter when you buy the property. Number 2, second thing to keep in mind is that over a long period of time, real estate always tends to be up. Why? Because real estate is one of those beautiful assets that hedge inflation. It's not like stocks or crypto or anything like that, where just because inflation goes up, it's guaranteed to go up like real estate does. But over a 30-year period of time, we can safely say that real estate will not only inflate in value, but increase in value as well. And the third thing to keep in mind when we're talking about the when market, it's the most important thing, is that for us as elite real estate entrepreneurs and investors, when we buy a rental property, we're not buying it with the hope of the value going up. We're buying it with the intent to collect the cash flow. That's why we want to buy a rental property. Not so that it can increase in value and we could sell it where we would have to pay a lot of taxes, but to where we could structure it correctly and collect cash flow and create generational wealth. That's why we're wanting to buy rental properties. So for me, I don't care if the value of my apartments go up or down, as long as my financing is secure and my cash flow is predictable and safe. In my eyes, I'm still a winner. Now, the second type of market is obviously the where, and a lot of people tend to put focus on this as well. I mean, if I had a nickel for every time somebody asked me, where's the best market in your opinion? And I think people ask these types of questions because in their minds, they just have this magical place, right? Like Narnia or Disneyland, where they'll buy the piece of real estate, it'll skyrocket up in value, and they'll be able to sell it for millions and millions in net profit. And unfortunately, that's extremely rare and seldom ever happens. So I'll share with you what my mentors share with me, right? Because I actually asked that question myself many years ago when my mentors were teaching me how to invest in real estate. And I asked, hey, Mike, in your opinion, where's the best place to invest? And he said, hey, kid, come over here and lean in real close. And then he whispered, he goes, the best place is the one you pick. And that's actually what I tell a lot of my students and people who ask me that question all the time, is that there are pros and cons to every single place you're going to invest. So for example, if you're investing in my home state, which is Illinois, your taxes are going to be way higher. But if you're investing in places like Florida, which I have done before, yes, your taxes are going to be significantly lower than what you would pay in Illinois, but your insurance premiums are going to skyrocket. And what you pay for insurance, like hurricane insurance and flood insurance, is going to be way more than what I would pay in Illinois. So in my opinion, when it comes to picking a where and market and where you want to invest, I always follow what I call the 3 golden questions. The first question is there a significant population decline? That's one of the first things I pay attention to when looking at a new market to invest in. Number two, is there an oversupply of inventory, which means are they building too much? And as you guys may have noticed, number one and number two has to do with supply and demand. Population increase, decrease indicates demand. Oversupply of inventory or undersupply implies supply. And last but not least, number three, are there any municipal policies that may be threatening my business strategy? A great example of that is this trend of Airbnb short-term rental arbitrages. And well, I have a lot of friends who did really well making $5, $10, $15, $20, $50,000 a month with their Airbnb and nightly rental portfolio. But then a lot of times half their portfolio would be shut down, or almost all their portfolio would be shut down because of policies and laws that municipalities passed overnight. So these are one of the things I always pay attention to as well when I'm thinking about where I'm going to invest. So all in all, for you to avoid the mistake of being afraid of the market, here's my ultimate solution, which is number one, secure long-term and fixed rate financing, because that's what caught up a lot of people in 2008 and 2009. And number two, ask for what's called a regional market report, which if you have a broker contact, which it's very easy to find, just Google a broker that works in that area you want to invest in, and ask them for any market reports that were created and published for that particular area. And if you have a broker contact that works at a really big firm like Marcus & Millichap or even eXp Realty, chances are, no matter where you're investing, they're gonna have what's called a regional market report for you to be able to read. All right, last but not least, mistake number three, which is fear of the unknown and allowing that to stop you from making real moves. Now, here's the harsh reality. If you have a fear of the unknown, like let's say if you're wanting to do your first real estate deal and you just have this nervousness or you just fear what's gonna happen. And here's my best tip on what I tell all my clients that seem to help everybody get over that. And here is the truth and the tip. Is that if you are fearful of the unknown and if you're nervous about your first real estate deal, good, you should be. Because typically if you're nervous or if you're fearful of the unknown, it typically means you're underprepared. Maybe you haven't worked with a coach, or maybe you haven't done enough research on the market, or you're not as confident in your ability to run numbers. But I believe that's your subconscious telling you, hey, you haven't done the work necessary to actually be able to complete this deal at the level where you're going to be profitable. I have a very good friend of mine who a lot of you guys know in the real estate investing space who once told me, yeah, the way I did my first deal was I worked and I made action items like calling sellers and practicing underwriting deals. And I got it to a point where success wasn't a surprise to me. It's like, yeah, of course I closed on that deal that cash flows X amount of dollars. Like, this is all the work I did in the back end with calling sellers and raising capital and practicing underwriting deals and doing market research and doing a lot of the other things that we cover on this YouTube channel. Like, of course I closed on that building because look at the amount of hours that I put in leading up to that point. So if you haven't done all that back work, then yes, like you should be fearful of the unknown and you should be nervous. And by the way, that's a great thing because chances are that fear or that unpreparedness or the nervousness probably stopped you from getting into a really bad situation. And if there's one thing, a mistake that I've seen people make over and over again, is that they usually don't know how to run numbers on a deal. And that right there puts them in a lot of negative financial situations. So overall, for this whole video, just do three things. Number one, hire a really good attorney. Number two, secure long-term fixed rate financing on any deals you do and ask for a regional market report. And number three, learn how to actually run numbers on a deal. In fact, if you guys want to see how I and a lot of other experienced real estate investors run numbers on a rental property, click on this video that you guys see on the screen and it'll show you exactly that. So thank you guys so much for watching and I'll see you guys in the next video.